Welcome back to another episode of DeFi Revelations. I'm Kirk, the head of business development with Revelo Intel, and welcome back. Today we had a really good episode with the founders of High. Let's Get High, to be more exact, which is a controlled peg stablecoin, on Optimism, and a similar ilk to Reflexer, if everybody's familiar with Reflexer. So it was a great episode. We get into the difference between hard peg stablecoins, USDC, DAI, for example, and controlled peg stablecoins like Reflexer and now High, and really the evolution of High out of the Reflexer project. Where they really want to lean into, I guess, the immutable part of what makes Reflexer so strong, right, and so decentralized, obviously from a collateral perspective and a code perspective, but also they wanted to expand. They wanted to take on different collaterals to obviously adapt to an ever changing DeFi world with these LSTs and these LRTs that are coming out. So it was a really really good episode with Luke and with Kingfish. Kingfish is the best dressed human I've ever seen. So I'll have to figure out a way to compete with him next time. But I think you guys are going to enjoy the episode. We get into the difference between controlled peg and hard peg, as I mentioned. We get into the growth strategy for High moving forward, right? Which obviously in the stablecoin world, it's very very competitive. So I think they have the right idea about leaning into their strengths. We get into the immense arbitrage opportunities on a controlled peg coin, like High. So if you're an arbitrager listening to this episode, I think we've got something for you. As always, if you guys liked the episode, please hit the like button and subscribe, and we appreciate it. And we'll see you next time on the next episode of DeFi Revelations. Welcome everybody to another episode of DeFi Revelations. Really really excited today to have the guys from Let's Get High on. A project that I've been following for a while, but I don't fully understand. Like, I'm sure some of our listeners don't either. So we've brought on the co-founders Luke and Kingfish to talk about High a little bit, talk about its positioning in the market, and ultimately like what drives the stablecoin protocol under the hood a little bit. So welcome guys, really appreciate you coming on. Yeah. Kingfish came for business, he said. So we're ready to rock. First and foremost, want to get into you guys a little bit, maybe talk about how you guys got into crypto, and then definitely take us on the journey of how High was formed, and the reasons behind maybe why High was formed as well. So I don't know who wants to kick it off.
We can kick it off with background. I'm Luke, co-founder at High. I basically just do all like the computer technical stuff. Yeah, I worked as an engineer in like Web 2 stuff for 10 years and found crypto intellectually interesting and made the transition.
Hey, I'm Kingfish. I'm a recovering TradFi-aholic. I worked for 7 years in banking, private funds, capital allocators, stuff like that. Like in the 2020 timeframe, I was a secondary credit trader, and then during the COVID lockdowns, I was working from home at my kitchen table. One screen was work, one screen was trading crypto, and I just fell in love with it and quit that job and just went balls to the wall crypto full time. Like, I bring to the team like the economic finance underpinning. Big stablecoin nerd. Back in 2020, I was in the early days of the Discord on Reflexer Finance, just kind of working for free because I was passionate about it. And eventually, one of the founders at Reflexer just basically offered me a job, saying like, "Hey, do exactly what you're doing now. We'll just pay you to do it." And I said, "Okay." I've been kind of with the team ever since.
Awesome. Yeah, no, it's good to hear the various backgrounds of the teams that are building these things. So you mentioned Reflexer, right? And we were talking, before, kind of about the transition from Reflexer to High and some of the modifications you guys wanted to make. Maybe take us through that story a little bit. Like, why did you guys decide to build High from, kind of like the Reflexer model, and take us through that a little bit?
Sure. Can I back up even further and tell you how like Reflexer was born first?
Absolutely.
So, back in the early days of DeFi, for if your listeners were around back in like late 2019, early 2020, and some of that's even before I got into the space. It's just kind of like the oral histories that I've heard from the Reflexer guys back in the day, which was, and we kind of all saw this. It's everyone was messing around with DAI, right? Like Maker was around, and like it was like the revolution of decentralized stablecoins. DAI or MakerDAO made some choices that were highly controversial, trying to induce stability, right? If you go on like CoinGecko or CoinMarketCap and look at the price of DAI back in the day, it's all over the place. And sort of like the underlying economic idea of arbitrage wasn't working the way they wanted it to work. And so they came to a decision point and decided to introduce USDC as a collateral, right? First, it was USDC vaults or safes, and then it moved towards the PSM, and it's evolved today through real world asset backing DAI and all the big treasury operations that they have with inside that. And congratulations to them, like they've grown, but they made a choice, and that was to tie themselves to the fate of USDC. And that comes at a cost, right? Like, is that really the cypherpunk vision of having like, your collateral being backed in a bank account controlled by the US government or ultimately controlled by the US government, right? And so there was a cohort of kind of the OGs at Maker who said, this is not like the way I want to win. Like, this is not the future of crypto that we want to see. And so out of those ashes, a group spun off and formed Reflexer, where the big experiment was two things. It was what's called PI controlled stability, right? And they said, hey, we don't ever want this to happen again. We don't want humans to like make bad choices. We want to leave it up to the machines. And so the other experiment that was really big inside Reflexer was ungovernance. Everyone talked about governance. No one was talking about ungovernance, where you code out human intervention. They were very successful, in our opinion, on both fronts, and Reflexer's still around today, and we're still highly involved in the DAO over there. But the ungovernance experiment locked the DAO out of changing anything. So there's really no more experimentation that can happen besides some very narrow parameters that can be adjusted. But as the DeFi space evolved, we've kind of looked around and we've seen the rise of LSTs, we've seen the rise of LRTs, we've seen the rise of L2s, and we said there's a wide blank canvas of green space here where we can have more cool experiments. And so out of that was born the idea of High, which you can see our branding is like super memey, like it's very casual, like we're like it's there is like a joke subtext to this whole thing. But underneath all that is like, in my opinion, like super highly engineered code that's security focused. And so some members of the core team at Reflexer said, let's go try this, with some of the new experiments of being multi-collateral, being on L2 and some of the stuff we'll talk about later in this podcast, and, do High. So that's kind of the story.
So the team kind of spun out of the Reflexer project, right? You wanted to take things, multi-collateral. What was the driving force behind that? I think, right? Was the rise in some of these more exotic assets like, LSTs, like LRTs, which makes sense, right? I mean, you got to be able to support more assets, if you really want to grow, at the end of the day. But take us through maybe like some of what's happening under the hood here with High, and maybe you can explain first and foremost, like what do you think? Can you explain to the listeners what's the difference between like the hard peg stable coins and like the controlled peg, that you guys have introduced with High and with Reflexer?
That is the question we've been trying to find the best way to educate the market on for like, I don't know, 4 years. It's so one of my like, whenever I'm at a crypto conference or talking to crypto people, my shibboleth, or like the thing I use like tease out if these people know what they're talking about or like what type of conversation I'm about to have with them, is I ask them a simple question: why is DAI worth $1? Right? And I've asked that question dozens of times and I've gotten dozens of answers. Some of them are like really not good, and it's incredible to me how like users of a multi-billion-dollar protocol or multi-$100 million protocol, whatever metric you want to use, are just like, it's worth $1 because it's worth $1. It's like, okay, well, sure, I guess. But really, if you get under the hood on why DAI is worth $1, is because the protocol MakerDAO values the debt generated in a CDP position, right, as $1. Like one DAI equals $1. And the market forces are meant to balance that, right? If DAI is trading above $1, a minter or a borrower can mint one DAI, which is $1 of debt at the protocol, and sell it for more than $1 on the open market. And as they do that, they expand the supply of DAI, increase of supply, pushes down the price. Vice versa is true. If DAI is trading below $1, people can go buy up their debt on the open market for cheaper than $1. The idea behind PI-controlled stablecoins is that sometimes the market doesn't do a good enough job at doing that, right? Like, hey, if DAI is trading at 1.013, right? So there's a penny and a third of a penny on the table of arbitrage between the market. Is that enough spread for the market participants to go and deal with that? What we found before the USDC thing was that no, the market ultimately won't do it. It's because, not to get too like economic 101 on you, borrowing is a function of demand for leverage, right? And so if your only collateral is ETH, let's just make this a simple model. If there's not enough demand for ETH leverage or ETH collateralization or ETH borrowing, whatever you want to do to close that 0.013 spread, it's not going to happen. So what can we do to induce a better opportunity for borrowers or market holders to close that spread? Well, what we do is the controller at High or at Reflex, it works the same way, says, all right, you guys didn't close it when it was 1.03. How about this? Now the protocol values your debt instead of at tokens time $1. Now it values your debt at tokens times 99 cents, right? And so now there's a penny in 1.3, right, of arbitrage spread. So now it's almost double that opportunity. And then the market either closes or it doesn't. If it doesn't close, guess what it does again? It says, all right, now we're at 98 cents, right? And so that's the system. And it pulls, it creates wider and wider gaps until the market responds. Wider and wider gaps until the market responds. And so we have a long history of watching this effect for Rye, and it's worked fantastically. We've been super happy with the way it's worked. And now, look, every system has its own pros and cons. But what I will say is this. We are very proud that we have encouraged the growth and adoption of a system that is a credible alternative to fiat-backed stablecoins, right? Like, you can make the argument it's not as capital efficient as having a bunch of USDC and being doing whatever that is, but you have some real drawbacks in those systems that you're either okay with or you're not. And if you're not okay with those drawbacks, or you just want to encourage the adoption of credible systems, here it is. We created it. It's been working great for years. And so, in a 101 very simplified sense, that is the underlying technology of controlled peg stablecoins instead of hard peg stablecoins.
Alchemix Finance empowers you to spend and save at the same time with a self-repaying, interest-free, and non-liquidatable loan. Deposit your assets and access your future yield now. Available on Mainnet, Optimism, and Arbitrum. Head to alchemix.fi to get started. Gotcha. So I guess my question would be on the borrower side or on the minter side. Like if I come and I mint High, a time where the controller is valuing, my debt at $1, and the price continues to tank. Am I taking, are you guys seeing an increased amount of liquidations within your model versus maybe a model like DAI, and Maker, right? Because of this fluctuation? Or am I thinking about it the wrong way?
No, that's a good question. And over a long enough period of time, that would happen. But you have to consider the totality of this complex system all at once, which is extremely hard to do. And I don't believe anyone who says they understand complex systems of economics, because there's 1,000 economists out there for the meat space world, and they all have 1,000 different answers. But let's paint this picture. Let's take your example where you show up with, I'm going to do nice round numbers, so bear with me. Let's say at some point in time, $10,000 worth of ETH. And let's pretend through this entire example, the price of ETH doesn't change. And so you always have $10,000 worth of collateral. And you borrow $5,000 at that time worth of High. And let's, for simplicity, say at that time, High was worth $1 at the protocol. And then you took that debt you've minted and you sold it for exactly, what did I say earlier? $5,000? Sure, $5,000. But you wake up a month later and you got back from your vacation where there's no internet in the desert or whatever, and you notice that, hey, the market price of high is now, in an extreme example, let's say 90 cents for whatever reason, some crazy reason. Well, what would be happening is that, remember what I talked about? Hey, the market hasn't been closing that spread by itself. So what has the controller been doing? The controller's been raising the internal price of your debt. So maybe, and I'd have to get the Excel spreadsheet out to do the actual math on what this would mean after 1 month. But let's say directionally now the internal price of high at the protocol is maybe $1.05. What that's telling you to do, if you're that borrower, Kirk, is it's telling you, like, hey man, you need to go out and buy some high on that open market, raise the price of high, because every day you don't do that, or every block you don't do that, really, every block you're not doing that, I am increasing the value of your debt, trying to make you close your debt to decrease the supply of high, to increase the market price of high, to get back to that equilibrium. So like the market, you started, it was here, market price dropped off, right? And no one did anything. So it's going to start doing this. And that spread is that profit opportunity, either avoiding future losses or capturing profit today. It depends on what the market participants like total P&L is, on whether it's one or the other.
Gotcha. Luke, I guess, one thing I wanted to get into as well, right, is how liquidations actually work, within High. Maybe you can walk us through some of the liquidation engines that you guys have built, and like the auction house model that you guys have built, at the end of the day.
Yeah, for sure. So I would say that, like, in order for us to, allow borrowing against collateral, we need to be able to like seize the collateral and liquidate these positions when the value of the collateral drops. What we do is we have a series of oracles collateral within the High system, and as that drops, different collaterals have a different like safety ratio in terms of like what is an allowed difference between debt and like total value locked in the collateral. And there's a series of keepers, and when someone's eligible for liquidation, these external keepers can basically call a function in the system saying like, okay, let's liquidate this safe. When that happens, the protocol seat takes control of the collateral, and it will auction off the collateral for High to cover the potential, basically cover the debt that the user owed. And in doing so, that safe position will be closed, but the user can then claim like the leftover collateral. That's the meat of it for the collateral auction house.
A few things I would add there is our liquidation process looks very similar to a lot of alternatives out there, where like the protocol will seize the position and do an auction. The things that we do well at High that I think are an improvement on the overall space is that we have made our front end extremely usable for humans, right? If you go look at other protocols, especially on L1, auctions are taken care entirely by robots and mevers that are just like, good luck competing with them. Now, don't get me wrong, robots and mevers are very much participating in our auctions because you kind of want them there because they're very like they're very quick, and they do a good job. But at the same time, like from the beginning when we launched our front end, it was important to me because I'm not a robot. And I've always wanted to participate in these auctions, and I'm just a dumb TradFi guy who can only click buttons. I can't do what Luke does. And so, like, just this last week when we had this flash crash, we had a ton of auctions, like 32 different liquidation auctions or collateral auctions. And I would say, like, humans were very much involved in participating. And so that is a feature of, like, we are democratizing the space where, there is an interface in which humans can go and click the buttons. Like, you can compete with the robots if you want. And I think that's a pretty cool feature.
Yeah, for sure. It's good you brought that up. Yeah, like I have a bunch of auction robots that I'm currently not running because like it's fun to be able to participate like in the protocol, right? Like at the end of the day, it's just like an app, and we want our users to have delightful experiences using it, and it just makes you feel more a part of, involved in the community, like you have like a vested interest in the protocol, and you're actually like actively participating as a member of the community.
Yeah, I mean, and obviously it just creates like another avenue for them to profit as well, right? At the end of the day, so it's symbiotic. I'm glad you brought that up, because I've thought about this a lot, with liquidations across the space, not even just for like stablecoin protocols, right? Any kind of liquidation, right? And it's just so robotic, right? But I'm glad you guys have thought about like the other side of the coin, right? Where, yeah, I mean, it would be great if like if I could come in, as Joe Schmo, and just be able to take part in that, because again, it helps. I think it helps you guys too when you're trying to scale, right? You don't have to, you still have to do it, right? You have to go, interact with some of these parties, right, that run these bots. I'm sure you guys have to have some kind of, interaction with them to obviously, drive them to the auction house at the end of the day, and make it available. But, you can kind of, spread that out and even that out. It's where it's not so centralized. You're not so worried about it, and then you can scale.
That's a fantastic point. Like, just like you're right. Like we are, or a lot of other protocols are dependent on those robots showing up. And if for some reason they didn't show up, there's not a front end where humans can go click the buttons in an emergency. And so like part of this is not just fun, but there's a security element, a decentralization element here as well, that in case they don't show up, humans can go save the day.
Right. Yeah. So I think, where my mind goes for a lot of protocols I talk to, and I want to kind of get your guys' thoughts on this, is obviously like the sustainability of the model from a business standpoint, right? Where does the high team kind of get their fees from, in the process, and how does it sustain the team, moving forward?
We are really bad at paying ourselves. um, like really, really bad. So like just full open kimono, like we didn't take any VC money for this, and we probably should have. But like this, like High was entirely self-funded by the team. Like Amin Soleimani is like our kind of angel, but he's like the Reflexer DAO guy, right? And he was like, all right, like let's see if we can get this done. And we went way over budget, and I'm sure he's super pissed about that. But like, there's no like bank account with a bunch of VC money in there. We didn't sell a bunch of VC tokens. Everyone who got like DAO tokens like were either Reflexer users, part of our airdrop, or like part of the team that built the damn thing. That's a long way of saying like we are actively trying to get a bunch of grants. Let's put it that way.
This episode is brought to you by Pendle. Pendle is the market leader in the DeFi yield sector, operating as a permissionless yield trading protocol, facilitating the tokenization and splitting of any yield-bearing asset in DeFi, while creating an avenue for users to express their views on future yield or earn a fixed rate with their assets. Learn more at pendle.finance. Gotcha. Fair. I mean, I like the transparency about it too. I mean, to be honest with you, though, I mean, there's a certain, it's like the ethos of DeFi almost, right? There's a lot of projects that raise a lot of VC money, right? And the users of the protocol end up being exit liquidity, at the end of the day. So it's good to see that, right? And I think it ties into really like optimism in some ways. I think of Velodrome all the time when I say these things. It's kind of the same thing, right? Like no VC money. There wasn't all this Ponzonomic game going on under the hood. Well, it is solidly, but it's kind of it's kind of pure, in that sense.
Yeah, you see like a new protocol launch, and it's got $100 million of TVL on day one. You kind of have to scratch your head and say like, all right, I can see what's going on here.
Yeah, I've seen a few. I've seen a few in the recent weeks in the stablecoin world doing things like that.
I mean, we've been running the protocol for like 9 months, and we only started paying ourselves like last month.
Yeah.
Outside of that, we're just kind of like working for free. So I think there definitely is like this purity in the like philosophical part where like we're just showing up every day, like doing an honest job to build like a like a product that we think is cool and has value to users, and like nothing shifty, going on. Yeah, full open kimono. That's a good way to put it.
Yeah, open. I have not heard open kimono before, so I'm gonna have to use that, later on in life here. So no, and again, it makes sense. It makes sense. So I guess you brought up the kind of the market downturn, this past weekend, and kind of the liquidations that happened. So I think it was a good stress test, right, for a lot of protocols in the space. I haven't seen a lot of things that really broke, down too much, which is awesome. It's always great to see. But how are you guys feeling, after you saw how high kind of reacted to that downturn? I saw your post kind of summarizing, how it all went. So like, what went well? What are some things that maybe you guys are looking at tweaking a little bit, coming out of that?
Sure, Paz, you want me to do it, or you want me to turn it over to you?
How about you do it from like the econ standpoint, and then I'll fill
Sure.
in any technical
Perfect.
like gaps that come up.
Yeah, so me and our other co-founder Reza wrote that Twitter thread yesterday after like looking at this after like as an after action report, because you put it well. This is kind of our first, I would call it, real stress test. I mean, whenever ETH drops like 20% in like an hour or whatever it was, like you're kind of sitting there going like, okay, here we go, right? Like we believe it'll work, but like you never know until you know, right? And I will back up and say, like, again, this is all based off of like an updated version of the Reflex or Rye code base, and that's been through everything from like 3AC to Luna to FTX, and like never had a single issue through all of that. So like we knew pretty well that like we were going to be fine, but like again, you're always kind of stressed, right? But everything worked like perfectly. Like I said, we had like 32 different auctions for like a huge amount of high, considering our circulating supply. It was like 30 something. Yeah, like it was a huge amount of high that like had to get liquidated off the market. And I was like, wow. And it worked fantastically. The protocol, so like to give you like the full like numbers and stuff off the top of my head here, going into the weekend, the protocol had about 40-ish thousand dollars worth of high and surplus buffer. That was like the bucket which you could, like, the first line of defense after the auction to cover any accrued bad debt. From those liquidations, the protocol made another 40 grand-ish of high to cover bad debt. And within the auctions, there was, I think we ended right now, I think there's a smidge over like 8,000-ish dollars of like bad debt in the system, which is like, ooh, scary. But here's where it gets like really not scary. Because at first I was like, oh, wow, we, by the skin of our teeth, right, fellas? It's like, no, well, first of all, that 8,000 was more than covered by what we had going into it. That 8,000 was more than covered by what we made during it. And here's the really cool part. That 8,000 was more than covered by the liquidation penalties inside each auction that had bad debt. In other words, the way the system works is if you get liquidated, Kirk, say you were a bad boy and you got too over levered over the weekend, and you had a 50,000 high safe. When you get liquidated, the protocol asks, depending on the collateral, let's say it's WETH or wrapped ETH, the protocol asks not for 50,000 high to cover the debt, asks for 55. The liquidation penalty goes to the surplus buffer. If you look at each auction in which a certain amount of bad debt accrued, in like somewhere like 200, somewhere like 1,000 or whatever, in each individual instance, it was more than covered by the liquidation penalty generated in the auction. In other words, of like the real debt, we were full surplus the entire time. And that's a pretty incredible statistic, considering that, like, again, ETH dropped 20% like an hour. So like that was a real stress test for like an incredible amount of over leveraged degens that we had on the platform, myself included, and we came out unscathed. Actually, the protocol made money. So
Right. Well, that's what you want to see at the end of the day. I'm always curious on the auction side, right? Because you said, obviously there's some human interaction that can happen. Obviously, you guys, have, bots going on too. But how long did it all take? Like how long of a period of time are we talking for all of these liquidations to occur, all of these auctions to occur? Like roughly how long did you guys see that play out?
A couple hours. I mean, if there's an opportunity to like make profit, someone's going to come and take it, right? So it's not like the auction's hanging out. It just, everything gets closed pretty quickly.
Nice.
Another way to look at it is the oracles in the system have like a 1 hour grace period. So like if you're a user and you're like, I'm about to get whacked, right, in a liquidation, uh, the price of like ETH, for instance, updates once an hour. And so you have kind of that grace period to like fix yourself. If you don't, you get liquidated. And then from there, our auctions start at a 0 discount. And over the course of 2 hours, they'll run their full discount. And that depends on the collateral. For like, I think we're running at like a max discount of like 15%. Some of our longer tail alts can go like 20+%. But you'll, to Luke's point, you see like auctions get cleared out once there's a juicy enough opportunity. And remember, it's like if you don't take it, someone else will. So that like auctions cleared out in, yeah, I'd say less than 3 hours from like total time of like ETH starting to crash to like it's all done.
Gotcha. Luke, was there anything you wanted to fill in on the technical side of how things went? I thought I saw something at the end of the summary about the oracles and maybe having to adjust the something to do with the oracles.
Yeah, so Kingfish can speak more intelligently about that situation, but I would say like we are exploring that.
Good news is it doesn't really affect anything from like the liquidation side. This was specifically the high oracle, and not for the protocol, but for like what the system thinks high is worth in the market. And we use a TWAP system to prevent people from fudging with like like holding hostage for like up on like if they know, okay, on this block they take the oracle. If for one block I can make the price of high like $80, I can really mess with like the controller. For that reason, we use a TWAP, and the flash crash revealed some inconsistencies that I think just like some minor changes to our order. It's believe it or not, I think it's an order of operations problem, right? We're like we're adding this together, then multiplying. We should be multiplying, then adding things together, type thing. That introduced like a couple cents of error in the market price read because like I was of course sitting there the entire time with like TradingView and Dex Screener and like everything all up on the graphs. And I'm like, okay, let's see what's like going on here, is or like making sure everything's all good. And I was like, hey, like that looks a couple cents off from what it should be. And so Luke and I are, and some other core DAO contributors are just like on Discord ripping through the code right now. And we're like, oh yeah, okay, like we can make this better. And that's kind of the cool iterative DAO process that I love.
Yeah, absolutely. I mean, and again too, like it's with these stress tests, it's always good to kind of go through and see things that you can fine tune, right, at the end of the day, because obviously this is crypto and these markets are crazy and the world is fucked up right now. So I'm sure there will be another another event, right, where this all happens again. So definitely a good time to like go back through and kind of look at things. One thing I wanted you guys to get into a little bit for me is this concept of the market price versus the redemption price a little bit, and how those two things are set. I think I understand from a high level how it works, but maybe take us through the market price of high and where that market price comes from, and like the redemption price, and like how the controller kind of manages those two things.
Sure. I could start with market price and I'll let Luke pick up on redemption price. Market price is like easy to understand. And like I just mentioned, like sometimes hard to implement. Market price is like, what can I go buy high for right now? Right. So and no one can control that. Right. No one can control the market price of, no protocol can control the market price of anything. Like there are systems you can put in place to encourage things. Right. You can put incentives in the market in smart ways to like encourage stability. But ultimately, no one can control. Like Kirk, I can't stop you from. I'm sure you got $10 million in Bitcoin right now, right? I can't stop you from market buying $10 million of high with your Bitcoin, and so that's going to have an effect on the high market price. That would have an effect on USDC price if it was big enough, right? And so the market price is simply like what is high trading for in the open market. And so what does that really mean? Like oracles is an entire industry within crypto. Like what is the real price of something? And so what we use is we have a Uni V3 WETH high pool on Optimism. That is kind of like our Bible, right? That's like what we say. Like that's the market price, right? And of course, one of the really cool things about Optimism, and I am like a big cheerleader for this, is like if you watch any token, it could be high or anything else, any token that's got like multiple AMM venues across Optimism, the robots on Optimism are like best in class at evening stuff out. Like let's just say let's use ETH, right? No one can get mad at me for using ETH. Like if you go on like Velodrome or Uniswap, there's a ton of pools that like have a quote token, like token A and ETH, right? The robots go in and like that ETH within like 15 seconds is priced correctly. So we have the same thing for high. There's a couple different high pools, but like the one we care about is the ETH high pool, and we say okay, there is a ratio of like how much high is worth one ETH, how much ETH is worth one high, and then we take the Chainlink USD price and take a TWAP of that ratio of ETH and high, multiply it by the current Chainlink price. That is what the protocol, like the little elves behind me, say that's what high is worth. Okay, so that's one side of the equation you're talking about. That's the high market price. I'll let Luke pick up on redemption price and how that works.
Yeah, the redemption price is essentially like what the system is like valuing, your debt in. So let's say the redemption price is dollar, and actually I'll see what we have live. Yeah, so like right now I'm seeing the redemption price is basically $1.03, and the market price is roughly like 97.5 cents. So essentially what like that's saying is I can be purchasing high on the market or 97 cents, but like paying off debt at a rate of like 1 point whatever 03. So there's like a spread there, right? So like there's like when the redemption price, and Kingfish kind of touched on this like earlier, right? And that's what helps move the market price. Yeah, that's pretty much the gist of it.
Yeah, so I mean, so essentially, I guess you guys have kind of created like an arbitrager's dream, right? When they can come and kind of play these two, kind of against each other, right? Which obviously you want to have happen, right? That's the only way that you come back to stability. So no, I think it makes sense. Okay, I want to get into a little bit of the growth strategy for you guys too. How have you guys seen the rise of high so far, and where do you guys plan on taking it moving forward in terms of like positioning it? Obviously there's a lot of competition in the stablecoin markets. So what are some of the things that you guys have coming up that you're really excited for, that you think is going to drive, adoption of high, and of usage of the protocol?
Yeah, sure. We have a ton of stuff on our roadmap, and I just have to think about where to start. I will say it's like when we launched, we knew we didn't have everything we wanted, but we did know that like our core product of like being able to show up with collateral, being able to borrow against it, and having a PI controlled stablecoin worked fantastically. We have all the oracles in place, all the keepers in place. Like the core functionality of the system was like in the oven, ready, good to go. Let's carve up the turkey, right? But it's like now that we've launched and now that we've even stress tested the product that it works, your point is a good one. It's just like, okay, what's next? And we have a ton of different things. Like first of all, like go check our governance on Tally. Like Luke has been awesome at like hearing what the community wants and tossing up like, I mean, how many proposals have we done since launch? Like 40? It's some like an incredible number. Yeah, it's like we are like extremely active on governance right now, and that's like what pushes us forward. I will say, I wrote a little forum post that I put up yesterday about like some of the stuff on like where the puck is skating to right now. So you mentioned Velodrome earlier, and I'm a big optimism user, and like I said, I'm a TradFi guy, and I get all horny over like yield. Everyone else makes 50x on cool tokens, where like I've been in crypto since 2020, and I still get excited over like 15% yield, right? I can't get the TradFi out my DNA, and so obviously Velodrome is a really interesting market and has some really interesting opportunity sets. But one thing that bothers me is that like there's nowhere to go to borrow against your Velodrome LP, right? And so like, hey, if you want to be the guy who's collecting all those Velo emissions on your favorite pool, and say you've locked up a nice chunk of change in that, like don't get me wrong, you're getting an incredible opportunity, maybe yielding like 10-15%, whatever it is, but that's not super capital efficient because that value is locked. If it's two stable coins, like it's very stable value, right? Like I'd love to loan against that at high, right? The DAO would love to have that as an asset. And so we've spent almost a month now researching like how do we make this work? Like what infrastructure can we borrow? What can we compose against? What do we have to write ourselves to create a system that would allow users to borrow against value locked in Velodrome? And I think we've come up with a really creative solution. Maybe your listeners have heard of Beefy Finance. They've been around the block for a while. They have auto compounding Velo vaults, right? That emit ERC20 token receipts, right? Well, we use ERC20s, right? So Luke came up with a really elegant way of pricing this, of like going all the way from like a Beefy vault token all the way down to the underlying collateral at the LP at Velodrome, and then pricing those out individually, and then compiling it all together back to like a dollar price that like plays nice with our system. I will say, big disclaimer, big asterisks. This like adding this collateral to the system is using code that is unaudited. And so for that reason, we have like big experimental tags everywhere. And when we launch this thing, we're probably going to launch it at like a debt ceiling of like 50 grand, right? We're going to keep this really small. We're going to do a little like test in production type of thing at a super small amount of value. And we're just going to see how it goes. If it does well, we're going to explore getting like this thing audited and really opening it up and making sure we've crossed our T's and dotted our I's. But like once we figured out that that's a real opportunity that we could possibly do, like that's going to unlock a whole new addressable market of value, not just for high, right? But that's a multiplying factor for Velodrome. That's a multiplying factor for Beefy, a multiplying factor for optimism as a whole, because it's like now all of a sudden, like if people are like looping leverage, which like, hey, that's a risk product, do your own research, not financial advice. But like all of a sudden, if you have, $1,000 at Velodrome LPing, if you can borrow against it at high and still get all the same economics, all of a sudden maybe you have, $1,500 or $2,000. And so it kind of like the tide rises for all boats here. And so I think that's a really cool product. We have some other stuff on the roadmap, which is super exciting. We announced a partnership with Dinero, formerly Redacted Cartel, and their liquid staking token. And they don't have a huge presence on Optimism right now. They have a huge presence and they're growing like a weed, right? But we're like, hey, why isn't Optimism doing its job and like courting these guys? And so we went out and did it ourselves, right? And so we've at the DAO, like some members of the DAO have been like really working closely with trying to like create a partnership that works for both parties, gets more TVL and Optimism, gets more TVL for our protocol at High, gets more eyes and ears on Dinero and what they're doing. And I think that's going to be a really exciting opportunity. Hey, Luke, you want to talk about our cross chain stuff we have coming up?
Sure. Yeah, we like the DAO gets reached out to, multiple times a week from, other L2s, other protocols. Like, we want to deploy like a high instance on Mode or Blast or Base, right? So there's like an enormous amount of demand for it. And we've just sort of taken our time and trying to, craft like the best cross chain strategy that will like allow us to do it as securely as possible. Not take any shortcuts. So what we've been doing is we've been working with Chainlink and their CCIP product, which is their cross-chain interoperability protocol that allows you to send messages back and forth. And I've come up with like kind of like a rough, roadmap. Like I think first off, we want to try to just basically allow like bridging of High to Base, for example. So because right now people want to be able to use High in other protocols, as a collateral, and allowing it on other chains is just going to like double the amount of opportunities and places you can use it. So like that's sort of like thinking like in the 1 month timeline, and then ideally like what we'd like is to build like a proof of concept where I am using High on Base, right? But I'm interacting like the High home, right, is on Optimism. That's where all the High is minted and so forth. But like I'm on Base, I can still like open a vault and lock collateral that's on Base, mint high on optimism and then receive that back on base. So basically it's just like taking the same actions, from like another chain. So, the goal there is to kind of get a proof of concept up and running with, just like the core user actions, like opening a vault, getting debt, repaying debt, liquidations, that kind of stuff. So I think these are all just like super rough timelines, right?
No.
Like,
I mean, it's probably hard to put your finger on, right? Like exactly when it'll go live, especially for something like this. The chain of the cross chain strategy, especially, right? I think is
yeah,
it's a complex one that I don't think everybody solved.
Yeah, I'm aiming for like 3 months to like have like a test net kind of deployment of like a single chain, right? This would be like, well, we're going to start with base because that there seems to be the most interest there, and then like zooming out a little bit, I see kind of like current high is like V1. I see like a V1.5, and I'm calling that like a full production mainnet deployment to like another chain, base in this instance, where you can actually interact with a live protocol with real money, real collateral, and so forth. That's like a V1.5, and like pending, how that goes, I could see us expanding to, other chains. We've been primarily like targeting the super chain, right? So like I could see us going to like mode after that. And then if like we're able to sort of successfully deploy with the strategy on a couple different chains, then we might take a step back and sort of consider like what else can we do like cross chain, and maybe that ends up being like a V2, and I'm not sure like what sort of features are entailed in that. I think the more will be revealed as we sort of traverse this cross chain path. But it's my favorite thing we're working on. It's the most like interesting coding wise, so it's pretty cool. Yeah, we're pretty stoked.
Yeah, from a technical level, I'm sure it's the most complex. So I can see why you're excited by that. Definitely, yeah. No, so it's great to hear that, guys. Always interested to hear like what the growth strategies look like, for everybody we bring on here. I think you guys are on the right track, especially with the LP tokens as well in the short term, because at the end of the day, there's a lot of exotic assets out there in DeFi, and everybody wants to borrow against them, right? LP tokens are a big one. They're also a very hard one to price, so it sounds like you guys have kind of dug through that already. So it's certainly something to look at, on the horizon for you guys as a good catalyst, I think, especially with the amount of TVL that's on like Velodrome, right? For example, like, so it's a good sync to kind of like tap into for kind of the next phase, for you guys. So
yeah,
so I hope it goes well.
Look, there's like, I also want to mention there's some longer term stuff. Like once we get those super easy things out the way, after that, like we have been whiteboarding some other really cool ideas. Like and they're kind of super intertwined with each other. And don't hold me to any details here, because like this is you only get one chance at like big overhauls like this. And I think we have come up with the broad strokes of a really cool way to do a redemption module. Think about like Liquidity V1, how like that's sort of worked, and it's been really good for borrowers, or I mean, excuse me, it's been really good for holders of LUSD. Not such a good experience for borrowers of LUSD. And so I think we've come up with a broad stroke way of like evening that playing field. Because one of the things you have to understand about CDP style stablecoins is that like there are two primary stakeholders, your borrowers and your holders, right? And they hate each other. They have diametrically opposed interests. Borrowers want the loosest borrowing terms. They want to be as risky as they can be, and and holders want stability and want as much protection as they can have, right? And so, like, how do you find a balance between those two things? And I'm not saying like LUSD did a bad job at that. They've done a really good job, but they've chosen, right, to be heavy in favor of LUSD holders. I think we found a way where like we can construct a choose your own adventure type style to this. And so that's like that we're calling roughly like the redemption module. And the other piece that's really cool and a little bit down the road after we execute on some of this other stuff is we're thinking about proposing an overhaul to the tokenomics of like the Kite token, which is our governance token, and how that interplays with liquidations, how that interplays with the redemption module, how that interplays with our surplus buffer. And I don't want to get too many details on that because that starts getting into like, vaporware. They never actually did what they said they were going to do. But it is top of mind for us. And we have some pretty creative solutions to make things pretty exciting for like more stakeholders in our protocol.
Awesome. I think it's a good note to wrap up on, guys. Really appreciate your time. I know it's precious these days. Obviously for anybody listening to this, check out the show notes, for how you can follow Kingfish, how you can follow, Luke here, how you can follow High and get involved in High. And then certainly, we'll be having some content coming out on Revelo Intel as well to help you through your journey. So really appreciate it, guys. We'll have to do it again here in a couple months and kind of check in and see where the growth is taking you. So appreciate it.
Yeah, thanks for having us on. It's been a great time.
Yeah.
Absolutely.